So let's take a closer look at the U.S. economy in Q3. The United States will likely experience low to moderate economic growth for the rest of the year. Anemic economic expansion in 2013 may be set the stage for the stronger performance in 2014. The path that will transform a currently anemic economic expansion into a more robust recovery has been bumpy, but the U.S. continues to make progress. The unwelcome news that the U.S. only grew by 1.8% in the first quarter of 2013 rather than 2.4% growth was the previously estimated is a reminder that 2013 is a year of transition. We do not expect sustained higher growth levels until 2014 as the economy needs time to adjust to the tax increases that went into effect at the beginning of the year and the cut in federal spending that began in March. However, even with these challenges, the outlook for the U.S. has improved to the point where attention is now on the timing of Federal Reserve's reduction and discontinuation of asset purchasing and its plan for its interest rates to rise to more normal levels. Based on a new and revised data, the estimate of the first quarter GDP was adjusted sharply downward in June, as the estimates for growth in consumer spending, business investment, imports, and exports were reduced. The largest downward revision was in the consumer spending, where the revisions were concentrated in service purchases, especially legal services, personal care services, and healthcare spending. The estimate for the contribution for consumer spending on goods actually increased. Another sizable change was the downward revision to fixed business investment that was primarily accounted for by a larger decline in investment in structures. The contribution from equipment and software held steady, albeit at a low level. For the remainder of the year, the U.S. should continue to experience slow to moderate growth with a slowly improving employment situation, setting the stage for a stronger 2014. Given the continued improvement in the economy, the Federal Open Market Committee of the Federal Reserve Board signaled in May and again in June that if unemployment continues to fall, it will consider whether to begin to decrease the rate of asset purchases, which is currently running at $85 billion per month. The FOMC also stated that if the conditions begin to deteriorate, it would consider an increase in asset purchases. Neither of these statements reflected a change in policy, but some market analysts reacted as the Federal Open Committee market was about to cease all asset purchasing and raise the federal funds rate target in the near future. And the stock and bond markets went on a roller coaster ride once again.